Shannon from Alphatrends.net. Today is Friday, the 9th of December, and we had a rough week here for the markets. Only thing that was up compared to Friday at this time last week was Bitcoin. So everything else, I mean, oil down 9%, the Russell 2000 down 5%, S&P and NASDAQ down close to 3.5%. Just a pretty brutal week. And, last week we got up to the declining, through the declining 200-day moving average. That's that black line. Hit the trend line from the high, and this was a level of interest that we know had the potential to show resistance. I wasn't bearish coming into this week because we were in an uptrend. That changed on Monday, and my opinion changed as well when we broke below 402. That was the level we spoke about last week in the video, that if things broke below 402, then they could look ugly, and we remained obviously below that level. Today we came right up to the declining 5-day moving average. And as I always say, I never trust a rally attempt with a declining 5-day moving average. That bounce up came from the place where it was supposed to bounce, the anchored volume weighted average price to the November low and this prior band of support. Now that we've seen a bounce that failed at the declining 5-day moving average, and then this sell-off here late in the day today, just I think sets it up pretty ugly for next week. Here's the 30-minute time frame, and you could draw a trend line that looks like this. I see that some people have been drawing a trend line, differently, that looks something like, off of this low and saying that the trend line has been broken. Either way, breaking a trend line doesn't mean we're due for an immediate reversal. It means the rate of ascent has slowed down. We're still holding for now above this prior resistance, which has been support. But as with any level of support or resistance, the more times it's tested, the more likely it is to fail to hold. So with a declining 5-day moving average, I'm really highly suspect going into next week and positioned accordingly. Let's look at that daily, let's look at the weekly time frame, because again, we still have a primary pattern here on this weekly time frame that we've been talking about the rallies that we've seen this year. We've seen some really big rallies, but we've seen bigger sell-offs. The sum of the declines all year has been greater than the sum of the rallies. That means lower highs and lower lows, which is the definition of a downtrend. It doesn't mean you can't make money on the long side as it makes these rallies, but you have to look at them with an eye of suspicion. By the way, I wanted to let people know that this is the cover of my new book that will be out in late January. I didn't take a great picture of it, but anyways, this is about the anchored volume weighted average price. It'll be available in late January, so I will continue to update that on Twitter as I always do. And anyways, back to the market, the NASDAQ, same story. Looking at the weekly time frame, we've got a declining 20, 30, and 40-week moving average. We're guilty till proven innocent, and a pattern of lower highs and lower lows. On the daily time frame, we've had a bounce. We're trying to still hold this level in here, this 280, 282 level, which was the prior resistance, which has become support. We're right above the 50-day moving average, which is rising. We're trapped below the 20-day moving average. Realistically, you look at this market on this time frame and you say it's neutral. We're in the middle of this range, the bigger range really being, from down here to the top end, and this has been the middle range. If we break below here, we're supposed to be in a seasonally bullish time of year, but seasonalities don't pay. Price pays, and you've got to listen to the message of the market. If we break down like this is what I was outlining to subscribers. I update these videos every single day for subscribers to Alphatrend, and I've been doing a lot of these videos for free on Twitter as well. So again, if you're not following me on Twitter, you're missing out. You're only seeing this stuff on YouTube once a week, where I update every single day on Twitter. So anyways, if we break down and bounce a little bit from here, you can pretty much look for this market, I think, to sell off pretty quickly and severely, because this has been a bigger level. If it breaks down and quickly rallies back up, then maybe that's a trap, a bear trap. But again, you've got to look at the direction of the primary trend and assume that it's guilty until proven innocent. The Russell 2000 is right down to the anchored volume weighted average price from this low right in here. That's that green anchored VWAP. We're also right at the rising 50-day moving average. So, this market is looking pretty ugly. Let's look at it on a 30-minute time frame. This has been the key level that I've been pointing out to subscribers as a support, and that if we were going to break it and find resistance there, things could get ugly, and that's what we have. Again, never trust a rally attempt with a declining 5-day moving average. This market is guilty till proven innocent. That's the 5-day moving average. That blue line, by the way, is the 20-day moving average. And, it's just looking ugly. The weekly chart, we've got a pattern of lower highs and lower lows. This low was lower than that low. This high is lower than that. This high is lower than that high. So if they don't scare you out, they'll wear you out. Maybe we're going to do something like this. As I've been, if you've been listening to me for all year, that's been the message. We're guilty until proven innocent. Markets are not likely to turn on a dime. Semiconductors are right up against their declining 200-day moving average. That's the 40-week moving average here. And here's what we see on the daily time frame. People have been pointing out this trend line and saying that it's bullish. They were holding above the trend line. And my thought about that is that, holding above a downtrend line, it's not a reason to buy, because we can still hold above that downtrend line and, be 10% lower here in the next month if it drops down towards 200. I think it's a terrible way to use a trend line. Instead, I think you're better off saying, this market has rallied up to the declining 200-day moving average and the anchored volume weighted average price from the COVID low. We have found resistance in this area so far. We're just above the anchored volume weighted average price from the November low, and we're trading in this range. So when we look at that range, we drill down to a 30-minute time frame and define that more clearly here. And you can see that, so far that people who've been buying in this range, well, they've been rewarded. But again, the more times support is tested, the more likely it is to fail. We had maybe a failed breakout here, and now if we come down like this next week, I would think that something like this would occur, a lower high. And then if we break down from there, then look out below is my thought, because we could head down towards that conjunction of the 50-day moving average and the AVWAP from the low this year. It's just still a rough looking market. The biotechs, we spoke about this group as they're above the 20, 30, and 40-week moving average. So does that mean we buy? We have the possibility of emerging stage 2 uptrend. Last week, I said, here we're in a stage 2 uptrend. I wouldn't buy here, though, because we're extended. What we want to see is a pullback that then materializes if it's above a flat to rising 5-day moving average. Instead, we saw a rally materialize. It was suspicious because of the declining 5-day moving average, and it failed today. So I am not calling this a stage 2 uptrend yet. It's not confirmed. It's looking like it wants to be. What I would prefer, as I pointed out, was a pullback first to make a higher low. The last significant low we had in here was down at this level, and that was down at 112. Here we are at 138. That's a big percentage move. If we're to pull back, shake some people out, and then rally up, then perhaps you'd want to be a buyer in here. But it's not just buying the higher high above a longer term 200-day moving average. It's how does it set up on the shorter term time frames to make sure you're in a position where you can appropriately manage risk. The XLE, I was pointing out this week that we had 3 things occur at this 85 level. We had this prior peak, which was trying to hold as support. We had the 38.2% retracement of this low to this high. That's exactly right here. That's what this means. That's a 50% retracement. That's a 61.8. We also had a rising 50-day moving average, and the anchored volume weighted average price from this low is that purple line. They were all coming together in this area. So I said, here's a level of interest. This is where we want to look for the potential of support to see if this market can turn around. So what we do when we're at a level of interest, we look to a shorter term time frame and say, is there any such evidence? And there has not been. So we look at it and say, okay, I don't want to be a buyer in there because we're below a declining 5-day moving average. We found sellers at the week to date VWAP, and we're below the volume weighted average price from the beginning of the month as well. So, buying perceived levels of support is not something that I have never suggested anyone do, not even to my enemies, because it's just not there evidence-wise that it makes sense to do so. Anyways, have a good weekend. Thanks for tuning in, and if you're still around, if you like the video, give it a like.